Welcome to The Explainer. Today we're going to break down one of the most powerful and, let's be honest, one of the most dangerous tools in all of crypto trading, leverage.
You've seen these numbers everywhere, right? The promise of massive returns, the idea that you can control these huge positions with just a little bit of capital. It's that dream of turning a small investment into a life-changing profit.
But here's the catch. This power is a total double-edged sword. Just as fast as it can amplify your potential gains, it can dramatically, and I mean brutally, magnify your losses. A tiny little market swing in the wrong direction can be absolutely catastrophic. And this number, well, this slide tells the whole story. A staggering 93% of new futures traders lose money. And the main reason? You guessed it, the misuse of high leverage. It's a tool that demands a ton of respect and discipline, but that psychological pull of fast profits, it just so often wins out over caution.
Okay, so let's really dive into the mechanics of how this all goes wrong. We're going to call it the liquidation trap. This is where a series of small, what seem like manageable events can suddenly spiral out of control into a total loss.
The single biggest mistake, the core of the problem, is just using way too much leverage. See, when you over-leverage, your position becomes incredibly sensitive to even the smallest market wiggles, turning what should be minor volatility into a major threat to your capital. And this table right here really shows you just how quickly everything can fall apart. At 10x leverage, a simple 10% price drop against you means your entire investment is gone. Poof! At 50x, a tiny 2% move, just 2%, wipes you out completely. This is the brutal math of liquidation.
So how does this actually work? Well, to open one of these leverage trades, the exchange needs you to put up some collateral. That's your margin. It's your skin in the game, the capital that secures your much, much larger position. And it's exactly what's at risk if the trade goes against you.
If the market moves against you, it sets off this dangerous chain reaction. First, your position starts losing value. If it drops far enough, your margin falls below the required minimum. That's when the exchange issues a margin call, basically screaming at you to add more funds. If you can't, or you don't, they force liquidate, closing your position automatically to cover the losses.
Let's make this super real with an example. Imagine you open a $20,000 Bitcoin position, but you only use $1,000 of your own money. That's 20x leverage. Now, in the crypto market, a 5% price dip can happen in minutes, right? That little dip erases $1,000 from your position's value, which just so happens to be 100% of your margin. And just like that, you're liquidated. So how in the world do you use this powerful tool without getting burned? Look, it's not about avoiding leverage entirely, but it's all about managing it with a disciplined plan. So let's open up the risk management toolkit you absolutely need.
Protecting your capital really comes down to 4 disciplined, non-negotiable strategies. Think of these as the absolute pillars of survival in leveraged trading. You have to master them. It's not optional.
First up, and I can't stress this enough, trading without a stop loss is like driving a car without brakes. It's an automated order that sells your position at a price you set beforehand, capping your loss before it turns into a disaster. This is your most important safety net, period.
Next, never, ever trade with just the bare minimum required margin. You always want to keep extra capital in your account. This margin buffer acts as a cushion. It absorbs those unexpected market shocks and gives you the breathing room you need to avoid that dreaded margin call.
This one is all about avoiding emotional decisions. Don't trade too often. That just racks up fees and leads to sloppy mistakes. And definitely never try to win back money after a loss. That is a recipe for disaster. A really good rule of thumb here is to never risk more than 1 to 2% of your total capital on any single trade. And finally, you've heard it a million times, don't put all your eggs in one basket. Spreading your capital across different assets, different strategies, it reduces the risk that one bad trade or one crashing asset can completely cripple your entire portfolio. Diversification is your defense. Look, at the end of the day, successful leveraged trading, it isn't about luck, and it's not about finding that one magical trade. It's about relentless discipline. It's about an unwavering commitment to managing your risk. It's about surviving the wild swings so you can be there to capitalize on the real opportunities. Okay, so now you get the defensive playbook, right? You understand how to manage risk, how to protect your account from getting liquidated. So the question becomes, how do you move from just surviving to actually intelligently growing your account?
In our next explainer, we're going to build on this foundation with some really advanced strategies. We'll get into sophisticated techniques for position sizing and capital allocation that will help you grow your account effectively and, most importantly, sustainably. We'll see you then.